They used to be called junk bonds before they were rebranded to high yield bonds, and for good reason. You're going to probably be very surprised at how the high yield bond sector has been doing this past decade. We're going to talk about it on this edition of Money in the Morning. Welcome to Money in the Morning. I'm Bobby Rebel from the Financial Grown Up Podcast, coming to you from my very grown up kitchen in New York City.
And from my mom's finished basement in the Motor City, Detroit, Michigan, I'm Joe Saul-Sehy.
And this is the podcast where we take the buzziest headlines. We don't just read them like those other podcasts. We get into why they actually matter to you, and we give you some takeaways so you can make it your own to live a richer life. Hey, Joe.
Hey, Bobby. Happy day. We are about to talk about junk bonds. Well, they're not junk bonds.
Calling it like it is. They're still the same product. They're junk bonds. They were just rebranded high yield bonds.
You dress them up differently like it's Halloween and call them something totally different, but still the same product. We going to learn about those today?
We are. We're going to learn a lot and good stuff.
Just when you thought the show couldn't possibly get better, it's time for your headlines.
How about if we talk about high yield bonds, Bobby?
Yes. Did you know the worst high yield bond fund returns in the decade? Do you know how they are, Joe?
I can tell you this comes to us from financial planning. Nice job. Comes to us from financialplanning.com, a place where financial nerds like Bobby and I hang out. This is written by Andrew Schilling. Andrew writes, all the industry's worst performing high yield bonds managed to post positive annual returns over the last 10 years. The 20 mutual funds and exchange traded funds in the high yield bond sector with the lowest returns recorded gains of at least 6%, Morningstar Direct data showed. The funds, which together hold roughly 96 billion with a B in assets under management, have all benefited from the last decade of steady market growth, according to Greg McBride, chief financial analyst at Bankrate. Quote, even the high yield bond funds that lagged over the past 10 years showed solidly positive returns, McBride says. This isn't altogether surprising with the backdrop of a 10-year economic expansion and bull market for risk assets. The industry's largest high-yield bond fund, the Vanguard High Yield Corporate Bond Fund, which is nearly $23.9 billion in assets under management, posted a 10-year return of 9.39% with a 0.13% expense ratio. Data shows the average expense ratio among the 20 worst performers, 0.77%, was 25 basis points more than the industry average. More broadly, investors paid an average of just over 0.5%, 0.52% for funds investing in 2017, according to Morningstar's most recent annual fee survey, which reviewed the asset-weighted average expense ratios of nearly 25,000 U.S. mutual funds and exchange-traded funds. That was up 8 basis points from 2016. By the way, we should say what a basis point is. 100 basis points is 1%. So 8 basis points is 8/100ths of 1%. A similar screen of the 20 largest high-yield bond funds, while carrying a slightly lower expense ratio, posted higher returns on average. Those funds, which have combined $135 billion in assets under management, had an average 10-year return of 10.16 and expense ratio of 70 basis points. So I don't want to go too much into this. I just thought, looking at high-yield bonds in general, this piece was about high yield bonds. I know there's a lot of people that don't even know what this asset is. A lot of people, Bobby, don't even understand bonds. So it's probably a good opportunity for us to kind of roll up our sleeve and talk about bonds with people. Like when we talk high yield bonds, well, why don't we start off with what you talked about during the open, which was we've seen the name change.
Yes. Yes. So there was a rebranding because there was a little bit of an implosion. I guess it goes back to the Drexel days, but I don't think we want to get into that. But there were some shenanigans, let's just say, way back in the day. And I think the industry has pretty much cleaned up its act in terms of that bad stuff. And now they are very much on the up and up. But the reason that high yield bonds pay more is because the companies are riskier. Just like when you go to get a loan, you may be.
Oh, I think we lost Bobby there for a second. Hopefully she comes back here. I think we're
young, but different things. So Go
There,
on, Joe. You were going to say something.
there she is. No, we lost you for a second.
Okay.
You blinked out. So I'm just going to finish the sentence I think you were doing, which was when you go to apply for credit yourself, what happens is they look at your credit report. So if you've got horrible credit, they charge you higher interest to get credit. So now you're on the other side and you're the person lending money. So when you buy a bond, you're lending a company money. When you buy a stock, you're an owner of the company. So you're loaning people money. What's the first thing you want to look at? You want to look at their credit. And if they have really bad credit, they have to pay you a high interest rate, which is the same thing as a high yield. So when you see the words high yield bond, that means high interest bond, which means bad credit companies that you're loaning money to. You become Bobby the land shark or Bobby the loan shark.
Well, yes, but the truth is that hopefully you're making an educated investment and you've looked into this company and you believe that they will pay the money back. They are higher risk and therefore higher return. And that's basically the way the market does and should work in a capitalist market. That's the market economy. If you are willing to take on more risk, you should get a higher return. But again, things sometimes do go south. And that's why they used to be referred to as junk bonds, because some of them were kind of junky and some of them were sold to people that didn't fully understand the risk. Hopefully now we have a more educated buyer. I do think that it's important to point out that even though the returns for even the worst ones have been pretty decent the last few years, I pulled up some information from The Balance, which is another website that I think explains things very clearly on a lot of topics. And they point out that the down years for high yield were accompanied by the economic slowdowns in 1980, 1990, 94, and 2000, or by the financial crisis in 2002 and 2008. So if you think the economy is headed for a recession, that's not the time to invest in high yield bonds. I'm not saying you should time the market. I'm just saying that usually high yield bonds are not a good thing to be in if the economy is headed south. And the logic behind that is pretty obvious. If the economy goes down, it's tougher for these companies that are already at risk to make money and therefore to make the payments to you.
Yeah, it's interesting how high yield bonds work for all the things that you talked about and the fact that you're getting this high yield. High yield bonds are usually better inside of an IRA or some type of a tax shelter because the main way you're making money is those interest payments back to you. And because of that, if it's not in a tax shelter, you're going to get hit much harder with taxes.
Well, their taxes income, not capital gain, is what you're saying.
Yeah, absolutely. Well, and the fact that they're throwing off way more than a stock does. More often throwing off that return, it's going to get taxed even if you reinvest it, because reinvestment's something you're just doing for because you want to. The government's still going to tax it. But that's often, by the way, Bobby, misunderstood by people. Like, well, I reinvested all that. Why should I get taxed? It was a convenience.
Yeah.
The government.
Well, and also, and people need to understand the difference between that. When you look at the yield, that's not the final return because you do have to factor in the tax that you pay compared to, say, muni bonds. A lot of people really like muni bonds. They're perceived as being very safe. And yet we've had some times, hello, Puerto Rico, where they have not been as safe as people had expected them to be. So just because something's a muni bond, people love them because what you get is what you get. You're not getting hit in most cases, and certainly not at all levels with the taxes. There may be some taxes depending on how that bond is structured. So you have to look at that. But you're getting a return that is an after-tax return in many cases, like triple tax-free. Muni bonds have risk too, though.
Yeah, you don't have to be an expert to know. Now that we talked about you're loaning people money, so the first thing to look at is their credit. You can go to Morningstar.com or a lot of other sites and look up the risk profile of the bonds, because the bonds inside of these portfolios, even if it's an exchange traded fund or a mutual fund, they will show you what type of bonds you're buying. And if it says junk bonds, you know that you're getting these very, very high yield bonds with companies that could go bankrupt at some point. That's why buying, and to get back to this for a second, Bobby, that's why buying these types of bonds, especially in an exchange traded fund or a mutual fund, way better than buying an individual one. Because you're going to get rid of that risk, which is a very, very real risk that this company could go out of business. Imagine loaning money to one company that could go out of business, but then instead loaning it to 150 companies, of which might go, maybe one or two do, but the other 148 pay you a much, much higher interest rate on that debt that they owe you. So some good stuff there.
is definitely important, as is watching the cost. I noticed that you paused a little in sort of disbelief as you noticed that the worst performing of these were also the most expensive of these. So that can boost your returns a lot too. You shouldn't always judge by the cost of things because that's not necessarily tied to performance. But it is a factor that if you are already not at the front of the pack and you're paying more in terms of the cost to the managers or whatever other overhead costs they have, marketing, et cetera, that's something to consider when deciding where to put your money.
Yeah, it's I'll say this about high yield bonds. I think they get a bad rap because of the fact that people think now, the way we explained it, that it is really risky. When you look at a risk reward pyramid of investments, high yield bonds are generally considered the highest risk bonds, which, by the way, is a lower risk than growth and income stocks. So stocks that pay a big dividend on the risk reward pyramid, looking at longer term, like 10 years and longer, going to be less risky and probably have a little bit lower return over an average 10-year period than a growth and income stock position would have.
And the truth is, high yield bonds over time in a diversified mix like these kind of ETFs and mutual funds do give competitive returns over time. And if you are skittish about the stock market, they can provide some diversification. But just remember that just like stocks, they can definitely be tied to the economy and their performance. So it's diversification, but it's also still tied to the big picture.
I love this idea, because people wonder, okay, cool, Bobby, Joe, sounds neat. Where do I use these? Well, match it to your goal. If you're somebody that has a long-term perspective and you don't like the risk level of stocks, this might be a decent option for you as long as you reinvest the dividend, number one. Realize you're still going to get a bumpy ride because of the fact that these are riskier bonds than normal. But also know it's going to be a little less risky than a stock would be. You're going to accept a little bit lower return than stocks, but you're going to get a higher return than a lot of bonds because you're taking more risk than them. So if you start with the end in mind, you've got a long-term goal and start there. Like with any investment, I think that's the place to start.
I agree. I think focus on what matters to you and then match the investments to the goal, as you said.
In just a second, we're going to do the big idea where we tie these two together. How are we going to tie Starbucks reward points that are changing to high yield bonds? Oh, we're going to do it. It's going to be magic. But first, I want to talk for just a second about Tiller, because this episode of Money in the Morning is brought to you by Tiller. The cool thing about Tiller from where I sit is that it beats every app out there in many ways, but one way that's super important. I was talking to somebody at this event I was at yesterday, and they were talking about how, well, these apps, they have these things you don't like. And I went, yeah, but I don't use those. I use Tiller. The reason I use Tiller is if I don't like it, I can change it. It's all spreadsheet based, which scares some people because who wants this really tough spreadsheet? The cool thing about Tiller, cool being the technical term, is that you start off with a spreadsheet, but you have a template that you work from, and you can choose from many different templates to see which one meets your needs. Then you press an easy button, which makes sure all your downloads, all of your transactions download. So whether it's your position at your brokerage account, your high yield bond funds, the amount of money you spend at Starbucks, whatever it is, it downloads very easily. You can change the spreadsheet however you want. To get 2 months free, they'll give you 1 month if you go to the site, but if you use our link, you'll get 2 months. Head to stackingbenjamins.com/Tiller, Tiller. And that's how you get that goodness, an extra month. So speaking of goodness, Bobby, it's time for the big idea.
Good. I'm glad we're moving on. I feel like you were looking a little bit too directly at me when you were talking about that Starbucks spending.
Yeah. Starting to sweat.
Starting to feel a little judged. Joe, I know a little too much about all their little rewards and special deals.
No judgment at Money in the Morning. I don't do it, but hey, might be good for you.
The big idea.
I think the big idea today, Bobby, is this: is that whether it is a reward point system or using high yield bonds, if you know yourself first and you know what you're trying to achieve, and then work backwards. And realize that these are just tools to either on the Starbucks front or whatever the reward point game is, just to make it a little easier. By the way, and also knowing that they've got something they're looking for on their end. And when it comes to investments like high yield bonds, and if you use a high yield bond fund, those bond managers also want something. And you saw that if you use one with a high expense ratio, hasn't been as good for you if you use one that charges a little less. If you match your system and your lifestyle, whether it's the credit card, the reward system, the investment you use to your goal, begin with the end in mind, I think you're going to do a better job.
Choose what matters to you and invest in that. It doesn't pay to spread all of your assets to too many different things. It's better to, I should say, your investments to too many things. You should consolidate them in points with the point systems and get the best rewards. That's where you're the most value. You offer the most value to a company if you are focused on them, and you'll move up the different tiers. But be mindful of your spending. Don't fall into the trap. Still do what's right for you, whatever your investment is. And Joe's giving me the eye, like I'm getting a little bit personal about this Starbucks stuff. But the truth is that you should pick, whether it's airlines or hotels or a credit card, they will reward you if you consolidate your spending with them. So that's always a good thing. When it comes to your investments, focus on what's right for you. Don't let anyone distract you.
I was just laughing because being on a first name basis with your barista might not be as cool as you think it is.
No, I'm actually not. I don't know the baristas at the Starbucks, but maybe that's just there's so many Starbucks in my neighborhood. I don't know. I don't know about that. Just kidding.
Hey, hope you got something out of today. We certainly did. Thanks for hanging out, everybody, on Facebook. If you want to hang out with us, facebook.com/iStackBenjamins. Almost messed that one up. I'm Joe Saul-Sehy. Go stack some Benjamins.
I'm Bobby Rebell. If you want to live a richer life, you got to be a financial grown-up. Bye, everyone.
This show is created by Joe Saul-Sehy, hosted and produced by Bobby Rebell and Joe Saul-Sehy, is engineered by Caden Thompson, and all put together by a pack of well-trained ferrets down here in Joe's mom's basement. You'll find Bobby at the Financial Grown Up Podcast and Joe at the Stacking Benjamin Show. Go say hi to them there, too. Online, visit us on Twitter at Average Joe Money and at Bobby Rebell, or come join a live recording at our Facebook page. That's facebook.com/iStackBenjamins. I know you already know this too, but Money in the Morning is for entertainment purposes only. You should not act on anything recommended by a bunch of entertainers in a basement or even a Manhattan kitchen without first consulting your financial advisor. And second, dude, have your head examined. Have headlines you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins closed Facebook group. This show is a collaboration of Stacking Benjamins LLC and BRK Media LLC. Copyright 2019. All rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.